Hi there, this is Sri from Phillip Futures Singapore, and today's webinar will be discussing trading the mini Brent, the mini dollar index, and the mini dollar CNH. And this is first of three-part webinars held with ICE Exchange. All right, so we're gonna have senior analyst Ming Lam from Trading Central to use technical analysis to bring us through the market noise. The noise pertains to recent market events which centrals around the central banks turning dovish, trade war between the US and China escalating, subdued economic growth seen in the Eurozone, and what's more, we have Brexit to come. So amidst all these market events and uncertainties, we're going to have Ming Lam to walk us through the potential opportunities that we may have in the mini Brent, mini dollar CNH, and the mini US dollar index. And he should be touching on some currencies as well if you're monitoring the forex market. But before we hand reins over to Ming Lam, we're going to have a few words from Vince Turcott, Director, Asia Pacific Sales from ICE Exchange. Without further ado, can I hand the reins over to Vince? Vince?
Hey, thanks, Sri, very much. And thank you, everyone, for tuning in tonight and joining us for this first in our series of 3 webinars discussing products and trade ideas that are available to you on ICE Futures Singapore. My role in this is going to be pretty brief. I'm just here to explain to you a little bit about how the contracts work, what the value is of trading on ICE Singapore, and hopefully give you some pointers as to how to get started. The real show is with Ming, who is going to give you some workable strategies that we think will, invite you to take a little bit of risk in the market and start participating on the exchange. I want to thank our friends at Phillips as well for inviting us to come along and do this webinar. Philip has been with us since the start of ICE Singapore and has been a big supporter of ICE exchanges globally and one of our founding members of ICE Futures Singapore. So look, with that, I'm just going to get along and give you a little bit of an overview of the history of the ICE group. We are a little bit different than some of our competitors in that we are really a technology business that sort of evolved into that evolved into an exchange business. We started with being an exclusively, sorry, just a moment, let me move this out of here. We started being exclusively an electronic business. We've opened several exchanges around the world. We've acquired exchanges, and we have also acquired a large data business that we pretty much kicked off in 2015. But really that's not, as interesting to you, I think, as the value proposition that we have available for you at ICE Singapore. We built the exchange around this idea that the Asia Pacific clients would be drawn to a trading ecosystem that is really especially for them. There are no fees for our market data. We heard a lot of criticism when we raised our data fees on some of our other exchanges a couple of years ago, and we listened to that criticism and we built this exchange for the Asia users with no data fees. We also built in cash settled mini contracts that are based on some of our more successful contracts in ICE US and the ICE EU, and we're going to talk about 3 of those tonight. The exchange fees are exceptionally low, and we'll talk a little bit more about that later. What we're trying to do is create the lowest barrier to entry for the end users here in Asia Pacific that would give them an opportunity to trade using the same high quality infrastructure. In other words, the same credit integrity, the same market matching engines, the same technology that's available on the bigger exchanges, but at a much lower price and conveniently positioned in Asia Pacific under the retail, well, rather under the MAS, which has very strong retail investor protections. One thing I would say is be sure to tell your representative at Phillip that you want to see the ICE Singapore data. If you request them to let you have the data, it is available for free, and putting it on your exchange will give you an opportunity to comparison shop with our products versus other exchanges, and you can see that our value proposition will be very, very strong. We're really proud of the progress we've made with the exchange. We launched in November of 2015 after acquiring the old Singapore Mercantile Exchange. We closed it down and reopened it using ICE technology and our platforms, and have built a nice little business. We did about 2.6 million contracts last year in volume in 2018, and we're off to a good start this year as well. So we think that the exchange will continue to grow and will continue to provide value for the regional investors. We also have a broad selection of ISVs available. Now, many of you I know are POEMS users at Phillip, and again, I would ask you to make sure that your representative knows you want to see ICE data on your POEMS system and get that authorized and up and running. I'm going to take a quick look at one of the three contracts we're talking about tonight, the mini US dollar index futures. The dollar index has been around for a long time, since the 1970s, and it has only changed once, and that was when the euro was launched in January 1999, and the European currencies were all incorporated into the euro section of the dollar basket. The reason that we think that this is a superior offering, I mean, there's a couple, but when you're trading FX, and I know that many of you are FX customers as well, you're going to see that occasionally you can pick the wrong pony. You know, you're trading against the dollar, you might be trading dollar yen or dollar euro, you might be trading sterling or cable, CAN dollar, but you may pick the wrong pony occasionally, and you'll watch other currencies appreciate or depreciate against the US dollar while yours is left behind. So what we did, in comprising the dollar index and offering it as a futures contract, we give a chance for you to take a risk against or for the dollar and settle against a broad basket, which will, deliver fairly superior performance over a longer period of time than picking any one particular currency. As you can see, these dollar figures, or rather volume figures, are very good, and we have consistent bid-offer spreads, which is the graph on the right side of this slide, that are one tick wide all throughout the Asian day. This is because this contract arbitrages against the big dollar index, which is also open at the same time. I mentioned the exchange fees earlier. The exchange fees for trading the big dollar index for an end investor are $1.35 off the rack. So we trade the E-mini contract. They're 8 cents a contract, and each contract is 1/5 the size of the dollar index. So you can get the equivalent risk exposure for 40 cents in exchange fees with free data as compared to the big dollar index, which is $1.35. Again, we've constructed the exchange this way in order to draw interest from the end investor base, the retail base in Asia, and to make it as friendly an environment as we can for you to trade. The bid offer spreads are tight, the volumes are strong, and the fees are very, very low. This is a quick summary of the contract specifications for a mini dollar index, and as you can see, the one thing that I think that trips up people, we'll talk about it a little bit later when we're talking about the trade ideas, is it trades in a half a tick size. So, and it's only $1 per tick per contract. So 5 contracts is obviously $5 per tick, for half ticks. We offer a monthly report. Again, ask your rep at Phillips if you would like to receive this report. It's free. It simply goes over the relationship between the dollar index contract and the component currencies, as well as some of the other contracts that correlate very well to a dollar relationship, such as the Mini Brent and the MSCI World and Emerging Markets Indices. Let your rep at Phillips know if you'd like to see this. We're happy to provide it to you direct for free. We have also got a mini offshore renminbi, of course, a CNH futures contract. And I know that I think we're the 3rd exchange to launch this, and now there are a total of 4 with another exchange launching after us. We like our offering, and there's a couple of good reasons why. Obviously, it's a mini contract again. It trades on a fairly tight bid offer spread. Volumes have been, again, strong and growing. You can look on the left side and see the monthly volumes, just under 60,000 contracts. But because the arbitrage relationship exists between the other exchanges and the spot and forward mini or CNH market, these contracts trade in a very tight band, and the liquidity is very strong. Again, here are the contract specs. It's a $10,000 contract as a mini. It lists monthly, and it has the cash settlement, which is something that we think is fairly important. We had quite a lot of demand for that. We initially launched it as a deliverable contract, and the liquidity providers, which are a couple of the banks and arbitrage firms in Singapore, asked us if we could not turn that into a cash settled contract. And that's worked out very, very well for us. It also I think, eliminates some of the delivery risk that retail investors often face. And this settles in US dollar cash. That's it for the presentation that we have today. We'll cover the Brent in just a few minutes. I wanted to give Ming more time, though, to chat because his stuff is very interesting. But the Brent contract that you'll see us talking about is, again, a mini contract, very high volume, supported by all of the arbitrage houses in Singapore, and it has been quite successful for us. Again, it's cash settled, so that you won't be driving around with 1,000 barrels of oil in the back of your car, and it is highly liquid and supported by the volumes that we see in the big Brent contract every day. With that, I'm going to turn it over to Ming. Sri, if you wanted to jump back in for the introduction.
All right, thank you so much, Vince. Very comprehensive. We know exactly which contracts to look out for. And now for the start of the show, Ming Lam himself, he's going to walk us through some technical analysis charts, as well as hopefully clear the skies, and we know exactly where the opportunities are. Over to you, Ming Lam.
All right, thank you, Straits of Phillip, Singapore, and also thank you, Vincent of ICE. And now I'm Ming Lam. I'm now situated in Hong Kong from Trading Central. Trading Central is a technical analysis firm. We provide our clients with research on technical analysis on assets like stocks, commodities, and future and forex. All right. Now, I'm your analyst today, Ming Lam, and okay. Now, as you know, we are going to talk about three major ICE contracts today. Okay, three major contracts. But just like many things on the internet, we would like to give you some bonus. Okay, but unlike those other internet bonus, the bonus we are giving you are real, legitimate, and solid. Okay, what I mean bonus is some bonus charts other than the major contracts we are talking about. We will talk about those contracts later. Okay, first of all, as an investor of any market, I would like you to have a concept that we have to know where we are standing at the moment. Okay, in terms of global investment environment. When we talk about global investment environment, we should talk about stocks, okay? And then the major one should be US stocks. Now, everyone, ladies and gentlemen, this is Dow Jones Industrial Average and the US stocks market, okay? You can see that, wow, this is our Trading Central chart. It is very easy, don't worry, I will lead you through, okay? The horizontal lines are target, resistance, and support. For example, this green thick line, horizontal line, 26950 is a resistance line, and then the second one, 26,670 is another target line on the upside. Okay, another horizontal line, the blue one, thick line, horizontal line is our stop loss. In this case, it is a key resistance because it is above the current price here. All right. Down on the red, we have 25,200 is our first target, downside target, and the second target is I should get a laser pointer like this one, yeah. And our second target now here is 24,825. All right. Well, maybe you know it better than I do. The U.S. stock market, just like the other global markets, at the end of 2018, last year, the last 3 months, the last quarter of 2018 was very bearish. Okay, the U.S. stock was on the brink of a technical bear market as it lost 20%. Okay, but at the start of 2019, this year, it rebounded over 22%. Okay, and from the top, we saw in April, it has consolidated, or we can say it has dropped 5%. Okay, now I will also tell you the other indicators in this chart. Okay, now the thin red line is the 20-day moving average. The thin blue line is a 50-day moving average, and the green one is 200-day moving average. As you can see that the current price 25,347 is below the 200-day, the green line, 200-day moving average. It is not a very good sign. Whenever we are going to buy stock or we want to long a market, at least the current price should be above the 200-day moving average. Now it is below. And another not a very good sign is that you can see the red thin line is crossing below the blue thin line. We call this, that is the 20-day moving average is crossing below the 50-day moving average. Okay, we call it not a very good cross. Okay, we call it death cross sometimes. All right, the chart below it is a relative strength index. It gives us an indicator indicating the momentum of the current stock market. And now we can see at the moment we are a little bit bearish on the US stocks. But I would like to remind you that from the April high back to the current price, the US stock, the Dow Jones, has dropped about 5%. Okay, in a normal bull market, a consolidation of 5 to 8%, we can see is normal. All right. Now this is the US market. How about other? This is the MSCI emerging market futures. Even worse. You see, the moving average are badly directed. All right, and from the high to the current price, the emerging markets have already dropped 10%, much worse than the US market. And I will later share with you some reason behind the tumbling of the emerging market. It is related to the currency. Okay, we can see the rise, the strengthening of the US dollar is behind the downfall of the emerging markets stocks. Okay. Next one, back into Asia. This is Japan's Nikkei. Okay, you can see that all the technical indicators are badly directed, and we are technical analysts. We also like to draw patterns. In this case, we can see it has broken below a triangle pattern. Okay, this one, a triangle. In another sense, we call it like a coil. A coil. When you compress a coil and you release it, it just expands the energy. So just like this one, it dropped and passed through a coil and it dropped harder. Okay, this is the Japan's Nikkei. All right, now in Hong Kong, my hometown, we cannot be optimistic either. All right, you can see that the price is already below the 200-day moving average. And for the most part of the start of the year, we saw a rising channel, but this rising channel has been broken. I can tell you from April's high to the current price, Hong Kong stocks have dropped 20%, okay, 20%. US stocks dropped 5%, Hong Kong stocks 20%, and Chinese stocks over 13%, something like this. And you can see that for fundamental, apart from chart, on fundamental side, you can see that all these stocks dropping are related to one theme on fundamental or from the news side. Yes, it is the US and China trade war. Okay, you can see that Hong Kong market and the Chinese market are hard hit by the trade war, as shown in the stock market. All right. Okay, we go forward and we see the Singapore. Singapore is quite choppy, in fact. Also, it is now below the 200-day moving average, and we have seen a 20-day crossing 50 days. Okay, Singapore Straits Times has dropped 7% from its recent top. Okay. Now, I know that maybe you will be also interested in currency trading. Now, this is Euro. You can see the moving average, 200 days, 50 days, and 20 days are beautifully in place for a bearish picture, a very bearish configuration. Okay. You can see that the Euro has failed to post a sustainable rebound for this for the past 2 to 3 months. All right, and recently, you know what is happening in Europe? We have a EU election, EU Parliament election, and in the UK and in Italy and also in France, we see that the Eurosceptic, those who don't like the European Union, are gaining votes. Okay, and the traditional establishment parties in Europe are losing. Okay, and this is something behind the euro, the downfall of the euro. Now we are seeing to the area of 1.1 to the US dollar. Okay. Next, and I have another currency for you, a very famous one, British pound. As you can see, the 20-day moving average has also crossed below the 200-day moving average, a very bearish signal, And you can see all these candlestick bar are black, meaning they are all down. And the relative strength index is below the 30. Okay, 30 is a point when we see it is oversold, but oversold, it doesn't mean that it will rebound. Okay, and you can see, and you can tell me clearly what is happening in the UK. We have the Brexit dramas. We have the Prime Minister is resigning, and a lot of argument in Parliament, and this filter through to the pound, to the currency. All right, this is our view on the pound at the moment. Next, and Australian dollar, and maybe you can tell me how the technical indicators are placed. All right, still this one we call it Aussie. Aussie is still captured is still captured by the down-falling 20-day moving average. Okay, and by the way, do you know that the Aussie, this Australian dollar, is related to one economy, not only Australia. At some point, we would say that Aussie is related to China. It is a China proxy trade. Okay, some traders say that it is a China proxy trade. When China is in trouble, when the China stock market is economy is in trouble, and the Aussie will be dropping like this. Okay, so now for the free currency, I have talked about the euro, pound, and Australian dollar. They are all dropping. Dropping against what? Against the US dollar. So now we are stepping into our first major contract of ICE dollar index contract. All right. Now this is our view on ICE dollar index USDX. Okay. Now you can see the current price, it is above the 20-day moving average, and also the 50-day and the 200 days are very well directed. All right, you can see also that in technical point of view, we have higher lows. Well, you can see the US dollar index consolidate, rebound, consolidate, and then rebound, consolidate, and the low is higher one another. This low is higher than this one and higher than this one. So we are bullish on this one. So how about the targets? We are now setting our key support with the blue line. The blue line key support is at 97. Why? It is around the ascending 50-day moving average, the thin blue line. Okay, easy to understand. Okay. Our first target is at 98.35. Okay, it is our recent high. Okay, we think that we project that the US dollar index will at least go to this first target. And how about the second target? We sell it at 99.2. It is we call it a 100 Fibonacci extension from the low seen in March. Okay. Now, I want to, speaking about US dollar index, I want to share with you one more chart. Every time when I'm in a webinar, when I'm talking about US dollar, I always like to show this chart because our audience will always like to ask about when will it get to the 100 mark. The 100 mark is a very significant psychological mark for the US dollar. I can tell you that the 100 mark for the US dollar was last seen in April 2017. In fact, it was then in April 2017. It was in a downtrend. It marked a high of 103, above 103 at the start of 2017. Can you remember what happened then? At the end of 2016, November 2016, Mr. Donald Trump was elected as the president of USA. Okay, and the dollar index surged up to 103 at the start of 2017. But since then, it has been on a downtrend. And for the most part, but at the 1 year later, for the most part of 2018, we saw the US dollar index rising again. As you can see here, we can draw a rising channel for the US dollar index. So it should not be a very good chance to short this index at this very moment. All right, so we are long. Now, maybe you mostly interested in this chart. It is our trade idea, the first of the 3 trade ideas we are going to give out today. Now, I will explain to you easy, don't worry. Our stop loss is 97. Our current price, for example, is 97,665. Okay. Now, one point you have to be very careful is that the tick size of this contract. This US dollar index is marked to 3 decimal places. Okay, but one tick size is not 0.001. One tick size instead is 0.005. Okay, for example, in our trade idea here, which first of all we talk about loss first. We talk about loss first. Okay, from the current price 97.665, if it falls back to 97, okay, we say we have reached a stop loss level. We cut loss no matter what. Okay. Now mind this, it is very important for every investor or for every trader, cut loss. Okay. And it is painful sometimes, but you have to do it. And now, for example, if in case we go from 97.665 to 97, we have you just minus 97 from 97,665. You have 665, but it is just a numerical amount. How could you change that to tick amount? You divide it by 0.005, and then in this case you lose 133 ticks. Okay, it is $665 if you are playing with 5 contracts. Okay, on the other hand, if you reach the first target 98.35, okay, you will have a gain of 137 ticks. Okay, in our example, if you play with 5, you invest with 5 contracts, you have a gain of $685. Okay, easy, right? Okay, if you hold it up to the second target of our second target, 99.2, you have you win 307 ticks. Okay, for 5 contracts, your gain will be, your monetary gain will be 1,535. All right. I think it is not difficult to understand, right? Now, this is our trade idea on the US dollar index, ICE Singapore mini-USDX. Okay. Now, talking about currency, we have another currency for you. This is Chinese overseas yuan, CNH. Okay, it is a US dollar against the CNH. Remember, US dollar against CNH. Now, we want to show off a bit because this slide is one we did for our webinar back 3 months ago. 3 months ago, in February, we gave this trade idea to our audience. Okay, and at that time we were short, we were bearish on this currency pair, US dollar against CNH. Okay, at that time our stop loss was at 6.817. Our first target was at 6.706. Okay, and it turns out that the currency trading reached our first target at 6.706. Okay, and we hope that our audience could gain something. All right. Now, how about now? Now, our idea is we turned from bearish to bullish. Now we are bullish on US dollar against the CNH. You can see that the declining channel that we saw back in February, and the declining channel has been broken. There is not a declining bearish channel anymore like before. Now the price has jumped back up to levels above the 20-day moving average, above the 50-day moving average, and also the 200-day moving average. Okay, and you can see that the RSI, relative strength index, is pointing to a very strong upward momentum. All right, and on this technical configuration, we will place our key support at 6.82, like this one. Why? It is around the 200-day moving average. All right, and our first target, upside target, is at 6.98. Okay, why? It is our previous high seen in last year, at the end of last year. Okay, it is running back to this high to revisit. We call it to revisit this high again. Okay, and above this first target, we project the second target at 6.063. Again, it is a Fibonacci. It is a rather technical term, Fibonacci extension from the pivot point. The pivot point is the blue line. We can also say it is in this case it is a key support, or in this case, in every case we can see it is a stop loss level. Okay, no matter what, when the price see this reach this level, we stop loss. Okay, now trade idea. Maybe you are more concerned with trade idea. Now we are not following every technical analysis regarding the levels. Okay, in this case, we see there is a risk of topping, or a temporary topping for this currency pair. So we actively set our stop loss not at 6.82, but at 6.8998. Okay, it is from the chart. It is from the chart to make our risk reward ratio more proper. Okay, we should have a better risk to reward ratio when we trade. Okay, now the first upside target is still at 6.98, and the second target at 6.063. Now for this contract, I would like to remind you that the tick size is just like the currency, just like a normal currency pair. It is up to this currency pair is up to 4 decimal places. Okay, so the tick size is 0.001, 30 and 1, and then tick size for each tick size it costs $1 US. Okay, if it rise 1 tick size, you get $1 US. If it falls 1 tick size, you lose $1 US. Okay, in this case, if we set a very tight stop loss here, the red line, okay, in case it really reach our stop loss, we lost $456 US. Okay, our entry price is 6.9226 here, the black one. Okay, if we reach the first target, we have 574 ticks, and it will translate into $1,148 gain. Okay, if you sit for the second target here, 7.063, the profit will be 2,808. All right. Now, so this is our trading. Sometimes we have to we have to set a very tight stop loss according to the trading environment. Okay, this is yuan CNH. Okay, now the third one we are sorry, maybe I have some interesting point to bring to you, is that we don't know the reason behind. Well, we are chartists. We look at the chart, we observe, and we just make trade ideas out of the chart. And what is the real reason behind any movement? Sometimes we are not in details at the moment to find out. Just like this one, we have found a quite interesting chart for you. It seems that the Bitcoin, you know the Bitcoin, okay, cryptocurrency, is in a very strong inverse correlation with the Chinese yuan. Okay, so when the look at here, the red line, when we see the Chinese yuan is depreciating against the US dollar, the Bitcoin is rising like hell. All right, so it is a fun fact just want to share with you. Okay, now next we go to our next ICE Singapore Mini Brent futures. It is about oil. Okay, again, I would like to show off again for our February webinar. In February, in a similar seminar, we saw a very classical book type technical pattern as shown here. Okay, you know is it? It is a reversal pattern. And further, we have a special name for this kind of reversal pattern. Reversal pattern means that it was falling for the last quarter of 2018, falling very hard, and at some point it turns up and rise again. And you can see this one, we call it a head and shoulder. This one is the head, and we have shoulder on either side. At that time, in February, we were bullish on Brent, and we advised audience then to long. And our first target was at 71.15. Okay, second target at 75.10. And in fact, these two targets are reached. And in fact, Brent stopped and peaked at 75.6. Okay. Now Brent tick size is 0.1, and you can calculate the tick size. For example, if we take 3 contracts, and these are the profits that we could take if our February trade advice was taken. Okay, how about now? Now I remind you, this is the story back in February. How about now? Now, sorry, it seems that the Brent has run its course of the upper channel. Okay, the bullish channel has run its course, it seems. Okay, we see that the channel boundary, the lower boundary of the bullish channel has been broken, and Brent has shown a bearish pattern of double top. We have one top here, another top here. Yes, 55.6 it was the top we saw in April. Okay, now Brent, we are on the reversal side, we are bearish on this one. Okay, as also you can see that, can you see the red line, the thin red line is crossing below the blue line. Okay, this is the 20-day moving average, is crossing below the 50-day one. Not a very good sign. And we place our target now at 67. It is a recent low. Okay, 67, and then another second target, downside target at 64. 64 is it was the low we saw in February and March. And how about the most important one, the stop loss, 73. Okay, whenever the price is back to 73, we say, hey, we could not be bearish anymore at the moment. Okay, so this is for Brent, and yeah, this is what I talk about. Now, seeing in our scenario, let's say we take a fee contracts. We trade fee contracts of ICE Singapore Mini Brent futures. Okay, we trade fee contracts. Okay, our entry price, for example, is 70.08. Okay, our stop loss at 73 free contracts. If the stop loss is hit, we have 876 loss, $876 loss. Okay, if we reach the first target 67, okay, we gain $924. Okay, if we the brand even sink to $64, we have a gain of 1,824 profit. Okay, so you can see that this is trading. We will not be in a position. We will not in a long position forever. The market turns and we turn. Okay, and last, I think talking about commodity, you should also be interested in this asset, gold, spot gold. Okay, we have been hearing people saying that the gold is in reverse direction with the US dollar. On the rough scale, yes, it is. But if you really going to trade, if you really mind the levels, you say it is not the case at the moment. We are currently bullish on gold as long as it stays above the key support at 1,270. Okay. Okay. Once it cross below this level, we will turn bearish again. Okay. So ladies and gentlemen, these are the charts I want to share with you today. And any question?
Let's just take a moment to think about what Ming Lam has shared with us today. He covered quite a number of products, including currencies, as well as our three focus products in ICE. So if you have any questions, please do feel free to type them in the question box. Ming Lam, as well as Vince, if you have any very specific product related query, you can type them in the question box and we will be glad to address them. If you have any specific requests for your Phillip representative, I'll take down notes as we go along and I'll be sure to get back to you after the webinar.
And ladies and gentlemen, and I would like to share with one more point with the brand also. And you can see that the brand fell very hard at the last quarter of 2018, and it rebounded very strongly for the most part of 2019, and now it is consolidating. Okay, so what would you analog this to another asset? Yes, you're right. It is just like it is like a mirror of the US stock market. All right. Yes. Any question?
Ming Lam, we have a question from Peter Lai. He's asking if you could explain more what is a pivot.
Pivot. Okay, cool. A pivot is a point that we change our view from bearish to bullish, or from bullish to bearish. Okay, it is a stop. It is a key point. It is a key point signifying that our current view is no longer valid. Okay, for example, look at this Brent ICE Singapore Mini Brent futures. We set our power point at 73. Okay, so below 73, we see we are still bearish. We are shorting the market. We are bearish on Brent. However, if Brent rise to 73, we say that our bearish view is no longer valid. Okay, we have to change our view. Okay, or we have to stop our and we have to stop our trading. Stop our bearish view at the moment. Just like a car, you go forward, you have a forward, you put in forward gear, one driving mode. Okay, when it reverse to the turning to the back, you have to put it to end mode, stop it, and then reverse mode. Okay, something like this. The pirate point, we usually choose the very key level. Just like in this case, we choose the recent high as the pirate point. Okay, and sometimes we choose the technical significant point, just like the moving average, 20-day moving average, 50-day moving average as the key support or key resistance point. I hope this helped.
Right, there's a question from Mr. Richard Young asking about a 10-year bond trend. What are your thoughts about it?
Sorry, 10-year?
10-year bond trend. What are your thoughts about it?
10-year bond trend. Let me check. Maybe I don't have the chart on the moment 3, but I can talk about it. Is it okay?
Yeah, sure. Go ahead.
Yeah.
Go.
Yeah, 10-year US 10-year bond. Well, it is. We usually say the bond, particularly government bond, US Treasury bond. They are safe haven asset. Whenever the market turn whenever investor panic, they just jump from the stocks, which are usually seen as more risky assets. The stocks, they jump into the bonds, particularly treasury bonds. In this case, I know that recently the 10 years bond, 10 years treasuries are rising, and 10 years yield are dipping to 2 years low, something like this. But I hope and I advise Mr. Yao, is it Mr. Yao? Mr. Yao, to look at the stock market, the US, particularly the US stock market. If the US stock market just finished a consolidation, like I say at the very beginning, in a normal bull market of stock market, well, it is normal to have a consolidation, a pullback of 5 to 8%. Okay, now the US stock market has a pullback 5%. Okay, I hope I advise the gentleman look at the stock market first, and if the risk we call it a risk appetite return, we can see investor and trader jump back into stock rapidly all the time, and in this case, if you are still confident on stock trading, on holding stocks, I think you have to pay more attention to the stock markets first. Okay, and you can see if people jump back into the stock market, well, the bond market, well, the price will of course ease on the other side. Yes.
All right. So, do we have any maybe a final question for Ming Lam? If you have any queries on the products that we have covered today, I believe Vince is available as well. If you have a question pertaining to the ICE products. All right, thank you so much for being a wonderful audience. If you have any other questions after you have digested the insights shared by Ming Lam today, you can send your queries to this email address, which I'm typing into the chat box right now. It is futures@phillip, PHILLIP.com.sg, and we will get back to you on your queries.
All right. Thank you. Thank you, everyone.
All right. Thank you so much. Have a wonderful evening. We'll have this recording available for you so you can revise what we have covered in the webinar. If you would like to learn more about the products that we have covered from ICE Futures Exchange, we'll definitely share the contract specs in the follow-up email as well. So you can get in touch with us if you'd like to learn more or have the prices on your platform. All right. Thank you so much. Thank you so much, Vince, for being part of this webinar. And thank you, Ming Lam, as well.
Thank you.